Breaking, the U.S. Federal Reserve, Fed, has just held interest rates steady, meaning no rate hikes and no immediate cuts, a decision that has sent shockwaves through global markets. Across markets, stocks remain strong or surging, especially in tech and growth sectors. Gold prices have been volatile, with strong rallies and sharp pullbacks. Housing markets are reacting to mortgage rate expectations. We'll dig into that soon. The U.S. dollar has been sliding, though it has recently shown periods of stabilization. In this video, we'll unpack what the Fed's decision actually means, why stocks can surge even with uncertainty, what's driving gold's movement, the housing market response, why the dollar has been weakening, and what could happen next. Key risks investors should consider. Let's start with the Fed. Section 1, Fed Decision Explained. Rate freeze or pause. When the Fed freezes rates, it simply keeps interest rates unchanged rather than hiking or cutting. Recently, the Fed kept the benchmark rate in its existing range, around 3.75% after a closely watched Federal Open Market Committee, FOMC, meeting. Why this matters? Interest rates influence borrowing costs for businesses and households, valuations for stocks, yield on bonds, demand for safe haven assets like gold, currency strength, especially the U.S. dollar. By holding rates steady, the Fed signals caution on inflation, confidence in economic resilience, or uncertainty about future data. Recent commentary suggested the Fed expects possible rate cuts later in 2026, though not immediately. Historical context. Historically, rate cuts can stimulate markets, but they don't always coincide with immediate rallies. For example, in 2001 and 2007, deep cuts occurred alongside stock market stress before rebounds. So the current pause may reflect a balancing act. Contain inflation without choking growth. Section 2, Stocks Reaction. Why markets are surging. Despite the Fed's cautious stance, major U.S. stock indexes are holding near or at all-time highs. Key drivers. 1. Tech and growth leadership. Companies like NVIDIA and others tied to AI have helped push markets up. 2. Earnings over macro. Investors are increasingly pricing company earnings rather than policy surprises. Strong earnings can support stock valuations even when rates are flat or uncertain. 3. Discounted future earnings. When rates are steady, not rising, future earnings are discounted less sharply, helping growth stocks maintain valuations. Sector performance. Tech, strong, AI demand driving interest. Banks, mixed performance due to margin pressure if future cuts erode yields on loans. Real estate/housing stocks, sensitive to rate expectations. We'll examine this next. Section 3, Housing Market Reaction. One of the most visible effects of interest rate policy is on housing affordability. How housing responds to a rate freeze. Mortgage rates often correlate with longer-term bond yields. When the Fed holds rates steady with the expectation of future cuts, market long-term yields can drift lower. Lower expected yields can later translate to lower mortgage rates, encouraging home buying and refinancing. Record conditions. Recent housing data has shown. In some areas, homeowners are locked into higher rates due to past rate hikes, slowing sales. However, expectations of future easing and improved affordability could boost activity later in 2026. This dynamic is important. Steady rates can stabilize housing finance costs. Rate cuts can stimulate borrowing and sales. Section 4, Gold and Precious Metals, surging then plunging. Gold's performance has been volatile around the Fed decision. Why gold matters. Gold is traditionally a safe haven. It doesn't pay interest, so it becomes attractive when real yields fall. Recent moves. Bullish phase. Gold hit record highs, above $5,000 Oz in some reports, as inflation fears and rate cut expectations built. Sharp declines. However, recent news, including a potential hawkish Fed chair pick, sent gold and silver prices sharply lower. Why the drop? The market reacted to the idea that a new Fed leadership could remain independent and more hawkish, making future cuts less certain, boosting the USD and undermining gold's appeal. Even after the drop, precious metals remain higher than earlier in the year, showing lingering demand amid uncertainty. Dollar Bandnote Section 5. The U.S. dollar and currency moves. The U.S. dollar's movements are critical because it affects commodity prices, including gold, global capital flows, emerging market assets. After the Fed's rate pause, there's been periods of dollar weakness, partly due to market expectations of future cuts, but also periods of strength as expectations adjust. For investors, this means a weaker dollar boosts foreign earnings for U.S. multinationals. A stronger dollar can pressure emerging markets and commodities. Section 6. Risks investors must watch. Even in a rally environment, there are key risks. 1. Policy uncertainty. Debate over future rate cuts. Leadership changes at the Fed. 2. Inflation persistence. Inflation could remain above target longer than expected, making the pause less stimulative. 3. Geopolitical tensions. Political risk can pressure markets, particularly safe assets. 4. Valuation stretch. Markets at all-time highs face vulnerability if earnings disappoint. Conclusion and TAKAWIS 58 0060 00. Here, what this all means. White heavy checkmark Fed holding rates can boost asset prices when investors expect future easing. White heavy checkmark stocks can rise even in policy uncertainty if earnings are solid. White heavy checkmark gold's volatility reflects shifts in inflation expectations and central bank credibility. White heavy checkmark housing responds to long-term yield expectations. White heavy checkmark the dollar's moves affect every asset class. This is not a buy everything environment. It's a selective, data-driven market. If you want market insight that actually helps your decisions, drop a comment with 2026 market and tell me what asset class you're focused on next.